Hello, everyone. My name is Peter Young, and this is the first of a three-part series of interviews on a book called The Zero Interest Trap. I'm going to be talking to the co-authors over the next few days about this book, which is about the phenomenon of zero interest rates that we've observed around the world since 2008. And I'm joined today by Ronnie Stöferle, who is a founding partner at the Lichtenstein-based firm Incrementum, and also the author of the annual In Gold We Trust report, which is the most widely followed report on the gold industry, published every year in German, English, and Mandarin. And Ronnie is also the author of a great book called Austrian School for Investors, which I've spent a lot of time reading and studying, which applies the insights of the Austrian School of Economics, the thoughts of Ludwig von Mises, Carl Menger, Murray Rothbard, to the world of investing. And that's a fascinating read as well. So welcome, Ronnie. It's great to have you here today for the conversation.
Hi, Peter. Thanks for having me.
Great. So I wanted to start off, Ronnie, by talking about this phenomenon that you've referenced in the title, because many people will be familiar with the fact that since 2008, we've had very low interest rates around the world, close to 0%. But why is this a problem? Why do you refer to the zero interest rate phenomenon that we're observing as a trap?
Well, our book, I've got a copy here. It was really, I have to say, a huge success in the German-speaking world, and the English edition is slightly updated because so much happened in the meantime. And the book is essentially about the hopeless situation into which central bankers have maneuvered themselves. They kind of fell into this trap because they did not want to solve short-term economic problems, but they, like little mice, they were lured by cheese, and they gave in to the short-term and very short-sighted desire to alleviate superficial symptoms instead of solving the structural and institutional problems that we have. Now, how did we get into this trap? It is mainly due to this asymmetry of interest rate movements in the recent decades. What does it mean? Basically, since 1980, we have seen this asymmetry. So interest rates have been lowered more sharply than they have been raised in each economic cycle. So in other words, after a complete interest rate cycle, interest rates were lower than after the previous one. Just one example, Peter. In the last cycle, which ended July of 2019, the Federal Reserve reduced interest rates by a total of 5.2% and raised them by only 2.25%. And later on, we all know what happened last year. They lowered them to zero. But of course, at the zero bound, the toolbox of a central banker with, I would say, the most powerful tool being, the tool of lowering rates. Well, this tool isn't in the toolbox anymore, and that creates enormous amount of pressure on central banks, and that means that they have to become more, let's say, creative or destructive, I would rather say. So now we're seeing actually it's really crucial to understand those things, because from our point of view, we are not in a cyclical crisis. This is rather a systemic crisis. It is a systemic crisis of our monetary system. And we're seeing, and I think therefore the last year has been a perfect example that our thesis is accurate. We're seeing this declining marginal utility of debt. So you need more and more debt to see an effect. At the moment in the US, we need $4.50 in debt to manufacture $1 of economic growth. So given the dependence on debt to fund growth, higher interest rates are basically impossible, and they would inherently be destructive. So this is the short summary of this trap that we are in. And when we published the book in German, we said, well, actually the ECB is definitely in a worse situation than the Federal Reserve. But we also said that in the next crisis, the Federal Reserve will have to go to zero as well. And yeah, that played out pretty well.
So can you just explain to us why actually governments need to lower interest rates at all? Why do we need more monetary expansion in general? Obviously, we've got the zero interest rate bound, and that's a conventional monetary policy tool. But since 2008, we've seen rounds of quantitative easing. We've seen unconventional measures such as corporate bond purchases. And now we're seeing fiscal measures accompanying that, such as the stimulus checks and the furlough measures in many Western countries. So why is it that governments feel that they need to keep undertaking expansionary policy? Surely they should kind of cut back and allow some of these adjustments to take place that need to take place on a long-term structural basis within the economy.
Well, I think they are just very scared of a recession, because a recession, like every crisis, hurts, and a recession is a restructuring of assets, of prices, and normally, as an Austrian, a recession is something normal, something healthy, but nowadays I think it's already quite telling that everything in financial markets these days is about anticipating what the Federal Reserve will do next. So this is really the most important thing. Nobody talks about balance sheets anymore. Nobody talks about business models. Nobody talks about products. It's all about anticipating what will the Federal Reserve will do next. How big will the next round of stimulus be? And we're seeing now, with 1.9 trillion in the US, that's basically, that's business as usual. And I mean, 1.9 trillion in 2008, everybody would have said, well, that's impossible. It's not going to happen. But we're getting used to those measures. And I think, from my point of view, we're seeing that it is not only governments that are in a situation of over indebtedness. Is definitely governments. It's on a personal level. It's on the levels of corporations, municipalities, the financial sector as well. Now, the big question, of course, is why can't we really afford higher rates? And just recently we saw with yields rising that the market is getting very nervous. From my point of view, if you have a look at the numbers, we shouldn't expect significantly higher rates, especially significantly higher real rates, because this is really what counts, not nominal rates, but real rates. Just for the US, governments, households, businesses are in debt at about 80 trillion. So if the general level of interests rates goes up by 100 basis points, you've just pushed 800 billion or 4% of GDP basically into debt servicing. So the US can't really afford bond yields going up more than they have already. And basically, I think the US is in the same situation like most of the countries in the European Union, like Japan, like UK, and so on. And I think there's really many aspects to understand and and why we come to the conclusion that we just can't afford significantly higher real rates in this highly levered economy and in this debt-based monetary system where deflation just cannot be accepted. We know that economic growth nowadays is very much dependent on monetary interventions, like I said before. We know that the Federal Reserve is basically running the biggest hedge fund with roughly 8 trillion in assets. So any increase in rates would curtail growth will significantly affect the balance sheet of the Federal Reserve and kind of the P&L of the Federal Reserve. It would slow the housing market. I think it's really important. People nowadays, they buy payments, they don't buy houses. So higher rates mean higher payments. We shouldn't forget that one of the major bullish arguments for the stock market at the moment is that that we're seeing such low interest rates. Now, of course, if interest rates should be rising, we won't have that argument anymore, and it would quickly change, and it would probably cause a bear market in financial assets. And we all know that the Federal Reserve and basically every central banker, they're stressing these so-called wealth effects all the time. So, as the stock market rises, we all feel more wealthy. And then, of course, we start spending, and this will further improve our GDP and so on. I mean, we all know that this is pretty much nonsense, but the Federal Reserve very much believes in the wealth effect. And of course, I mean, that's also a very big question mark. We don't know what with the derivatives market will happen. So if should be a next credit crisis, where all the risks are basically hidden. We know that the lower the interest rates, the cheaper, of course, it is to take on enormous amounts of leverage. And the more leverage you have, the more sensitive you become to rising rates, obviously. And so those are all reasons why I don't think that within the next couple of years we won't see any significantly rising rates, and therefore I think what's happening basically confirms our views pretty well, because as I've said recently in an interview, 2 or 3 years ago, ideas like MMT and helicopter money, that was basically the wet dream of socialist economists. Nowadays, this is really becoming mainstream, and everybody says, yeah, well, MMT, that's only a matter of time, and let's try it out. Let's see how it's gonna play out. So this really confirms the view that we have to see much more aggressive measures going forward.
Yeah. And presumably the way you're talking there about all of these problems, the drop in the housing market and the fall in the stock market, presumably you would characterize these as kind of short-term issues rather than things that might have a benefit in the long run. Do you think that actually, if we are somehow forced to higher interest rates, that will impose a bit of restructuring on the economy that will be healthier for the long term?
Yes, of course. I mean, having a proper Austrian framework, I think it's obvious that at some point we will have to see this natural recession. But the longer you delay it, the worse it will get, and therefore I think I'm rather pessimistic, and I don't think that we will see market forces being allowed to work again. I think we're really moving into extreme interventionist system where market forces aren't accepted anymore, and that makes me very, very concerned, and that plays into our thesis that financial repression and capital controls and all those things will be further implemented going forward. And that doesn't really make me confident that at some point, we will see this natural recession. But we have to make the the best out of it, and we have to be pragmatic and just deal with the current situation. But from an Austrian point of view, it makes me very sad, very concerned that we're seeing exactly the opposite of the things that we would suggest.
Yeah. So in terms of where we are now, Ronnie, I've been listening to a lot of your commentary videos over the last few months. And one of the things I've noticed in your rhetoric is that whilst previously there was more of a talk of this battle between the forces of inflation and deflation and being unsure of how that's going to play out, you've more recently been talking more and more about how inflationary forces are winning out. And in the last couple of weeks in the bond market, we've started to see some turbulence, and we've started to see some upward pressure on yields. Could you just tell us a little bit about what's been happening in the last couple of weeks regarding the bond market and how you interpret that in terms of expectations for the economy and expectations for inflation?
Yeah, well, it's been pretty rough in financial markets the last couple of days, because yields on the 10-year, for example, they rose up to 1.6%. Now, on an absolute level, everybody would say, well, 1.6%, that's nothing, and it doesn't really compensate for the risk that I'm taking, especially when inflation is around the corner. On the other hand, yields basically quadrupled from the level that we've seen last year in summer. So it has been a quite significant move, and we saw similar brutal moves in yields in years like 1987, but also before the dot-com crash. We saw it before the great financial crisis, of course. So the market is getting really concerned because of this move in yields. Now, from my point of view, the Federal Reserve will have to choose between two different paths. First of all, they could say they underestimated the strength of and then they will start talking about tapering monetary policy. Mm-hmm. Now, the code, tapering, it is something that is coming from the world of running. I've got a picture here of Eliud Kipchoge, who was the first man to run the marathon faster than in 2 hours. And normally in marathon, if you prepare for a big competition, then you have to taper before. So you have to slowly reduce the amount of training. Now, this tapering, we saw it with the so-called taper tantrum in 2013, when Ben Bernanke, back in the days, he tried to cautiously prepare markets that quantitative easing is over, and that the Federal Reserve will withdraw liquidity, and we know what happened. We saw big turbulence in financial markets. So now in 2021, I would say that the size and the absurdity that we are in will make the taper tantrum of 2013 look like a kindergarten party. So any attempt of withdrawing liquidity or potentially just slowing it down will risk pricking the valuation bubble that we're in. So from my point of view, the only response that we can see, and that's basically the only way how to prevent any negative economic outcomes from higher long rates when we're locked at the zero bound, will be yield curve control. So this will, I've tweeted that a couple of days ago, I think this will really become one of the major topics going forward. And now yield curve control, that sounds a bit boring, but I think that in the next couple of weeks, everybody will know what it is. And basically, the Federal Reserve will have to say, well, we'll buy all bonds at maximum of, I don't know, 1.5, 1.6%. And, you know, we have already seen yield curve control. We saw it in the 1940s, but it would be the very first time that we're seeing such a measure in peace times. So it is something that we've already seen, but never outside of war times. Now, of course, I mean, we are now at the highest debt levels that we've ever seen, except for war times. And, you know, the United States will have to refinance 8 trillion in 2021. So they probably don't want to see significantly higher interest rates. And this is really the big fight that is going on at the moment, bond market versus the Federal Reserve. Of course, the Federal Reserve cannot act like too aggressively, too quickly. But I think at some point in the next couple of weeks, there will be the implementation of yield curve control, or perhaps they will come up with a slightly different name, even more, you know, a name that sounds even more sophisticated, because back then, quantitative easing, when it was introduced, everybody thought, wow, that sounds terrific. I mean, it sounds so smart, and nobody had a clue what it is. But I think it will be implemented very soon, and it will be the start of the next leg down in the US dollar and the next leg up in gold prices.
So can you just talk us through some of the dynamics of that? So for those of us who aren't familiar, what does it mean to implement yield control? What are the actual mechanisms that the Federal Reserve will undertake in order to change the yields of different durations of government bonds?
Well, they will actually say, you know, we put on a cap on yields, and as they can only control the short end of the curve, they will try to control or to massively intervene in the on the long side of the curve as well. So there's many smart people that are currently probably calculating at what levels yields should be pegged. I think around 1.5, 1.6% is a level that is pretty realistic. So it basically means that if yields try to break above that level, the Federal Reserve will say, okay, well, we buy this stuff. Yeah. So it would probably also mean that the balance sheet of the Federal Reserve will show a dramatic rise, dramatic growth. And I think this would just be the next step in this massive intervention in markets that we're seeing. Now, Peter, in the gold world, I always hear, well, the market is manipulated and there's so much interventions happening. But, you know, the biggest intervention out there is, of course, the intervention when it comes to interest rates. And I think, you know, intervening and basically controlling the price of probably the most important benchmark price in the bond market. And the bond market is significantly bigger than equity markets, of course. I think this would really be a major policy shift, but at some point they will have to implement it, because, as we've said before, they just cannot let yields rise significantly. I think this is over, and we over the next couple of years we will definitely not see real rates being significantly positive, like 3, 4, 5% plus, like we saw it in the 1980s and 1990s.
And is there a difference then between quantitative easing on the one hand and yield curve control on the other? Because the quantitative easing involves the purchase of longer-term government bonds, which is sort of what you're describing there in terms of pushing down the further away end of the yield curve. So is there a distinction between the sort of activity you would see through a quantitative easing program and through a yield curve control program?
Well, the major difference is most people thought that in quantitative easing, actually that yields would fall. But if you have a look at history, actually yields always rose in times of quantitative easing. So it is, I would say, exactly the opposite of what the Federal Reserve had in mind. So therefore, this would basically exactly achieve what the Federal Reserve wants to see, and I think it's really important also to mention that last year, I don't know if this is really legally allowed by the Federal Reserve Act, but it is, the Federal Reserve is now also very, very active in the loans market, in the corporate bond market, also in the junk bond market. They don't directly buy it. They buy it through special purpose vehicles that are managed by BlackRock. But I think it's really something that that has changed in 2020. Of course, in those really turbulent times where everybody was scared and nobody knew how it's gonna, how the next day in markets will be. I think they really crossed the line last year, and therefore I expect at some point the next taboo will be broken and they will implement this yield curve control.
Mm-hmm. Okay, well, one of the things that I wanted to talk about as well was, I guess, what this has meant, these zero interest rates, what they've meant for the economy and how the economy has developed overall since the financial crisis. There's been a lot of talk about the everything bubble. Prior to 2008, the bubble that we saw was broadly characterized by the housing market. And then prior to that, it was the dot-com bubble in the United States. And so since we had these unprecedented measures undertaken to lower interest rates and engage in quantitative easing, there's been an inflation in all kinds of assets, with commodities being the exception to this upward trend in recent years. So what is this concept of the everything bubble, and why is it a problem?
Well, I think, if you have a look at markets at the moment, it's in the bond market, we're seeing extreme valuations. At the moment, only 12 trillion are trading at negative yields. It was 18 trillion a couple of weeks ago. But still, this is a pretty big number. But we're also seeing that equity markets all around the globe are trading at or close to their all-time highs. We're seeing in real estate that is becoming really unaffordable for most people. We're seeing it in works of art. We're seeing it, of course, in cryptocurrencies. We're seeing it now in commodities, and we're seeing it in the specs market. That's like the next big thing. We're seeing it in Pokemon trading cards. I mean, it is really interesting to see how all this liquidity, where all this liquidity flows to. Just one number: the Bloomberg World Exchange market cap is now at 110 trillion. Which is 25% higher than before the pandemic. So the big question is, are the world's public companies now really 25% better off than before COVID? I would doubt it. And from my point of view, the interesting thing about this everything bubble is that previously in 2000, it was just one individual sector. It was primarily the dot-com space and the technology sector. But value stocks, for example, weren't that expensive in 2000. In 2007, it was, in the real estate market. Of course, this spilled over into the banks due to the financial engineering. But it was, those bubbles were smaller, and they were more regional, and they were limited to specific sectors. Now we're seeing it on a global scale, and we're seeing it in basically every asset class. And as a keen follower of the Austrian School, I had to reread Human Action, of course. And if I may read just a few sentences, where Ludwig von Mises is writing about the crack-up boom. I think it's quite telling, and I thought, well, this is exactly what is happening at the moment. So Mises writes, but if one's public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everyone becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. And then he goes on, the advantages of holding cash must be paid for by sacrifices which are deemed unreasonably burdensome. This phenomenon was in the great European inflations of the 20s called flight into real goods, or in German, Flucht in die Sachwerte, or crack-up boom, Katastrophenhaus. That's the German term. And then he says, these people still believe that prices one day will drop. Waiting for this day, they restrict their purchases and increase their cash holdings. As long as such ideas are still held by public opinion, it is not yet too late for the government to abandon its inflationary policy. But then the masses finally wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. A breakdown occurs, the crack-up boom appears. And, having a look at markets at the moment, it really reminds us of what Mises was writing about. And I think that having a look at market flows over the last couple of weeks, it is really this move into real assets, diese Flucht in Sachwerte, as we say in German, that is currently happening. And this is, of course, a very dangerous state that we're in.
So do you think that most people just don't realize that this is happening? Because it's still quite a controversial position to maintain that we're going to see high levels of inflation in the years ahead. In most mainstream circles. So I would imagine that's what you're forecasting, given what you're saying about the crack-up boom and given what you're saying about the limited options available to government. So why do you think it is that there's not more understanding of this amongst market participants and economic commentators?
Good question. I think, first of all, the definition of inflation is quite flawed nowadays. Yeah, the term inflation is commonly used to describe a rising price level, and deflation is a falling price level. Now, from an Austrian point of view, original inflation, the Latin word is inflatio, is expansion and enlargement. It was used to denote the expansion of the money supply or the circulation of paper money. So from our point of view, there's monetary inflation, there's asset price inflation, and then there's consumer price inflation. And we've seen enormous amounts of monetary inflation. We've seen this asset price inflation. Now, the third stage would obviously be consumer price inflation. And of course, we could talk about the calculation of those inflation baskets for quite a while. We know this hedonic indexing, geometrical weighting, and there were 20 fundamental changes of the calculation of inflation over the last couple of years. However, I think that people they feel and they understand that inflation is becoming a concern, and we should not forget that actually central bankers are very openly telling us we want to see more inflation, we want to see rising CPIs. And of course, the higher you're in debt, the bigger the fear that you have of deflation. So the higher the desire for more and more inflation. So from my point of view, we have seen over the last couple of months many moves that led this pendulum that was I would say a bit disinflationary or deflationary, and this would be the natural state of our monetary system. But I think this pendulum really moved to the inflation side. Now we're seeing, for example, this average inflation targeting. So the Federal Reserve tells us, well, inflation numbers were undershooting over the last couple of years, so we can accept that they overshoot for the next couple of years. Then we are seeing this very fundamental change in the direction. Well, we don't only have monetary stimulus, we also have a very, very aggressive fiscal stimulus. And I think the fact that Janet Yellen, former head of the Federal Reserve, now is the Treasury Secretary, I think the symbolic character of this cannot or should not be underestimated. We're seeing similar things in Italy, for example. Mario Draghi, former head of the ECB, is now becoming the prime minister in Italy. So I think this, as I've once said, this flirt between monetary policy and fiscal policy, this is now, they got married. And this is a very, very dangerous thing. Then, of course, we are seeing, as I've mentioned, MMT, helicopter money, and so on. And we are seeing that governments try to politicize the creation of credit via state guarantees. And we will write about that at length in our upcoming gold report. So basically, if the government says, well, we guarantee 2 trillion for a new Green Deal or whatever, every banker will say, well, if there's if it's guaranteed, if this loan is guaranteed by the government, of course, we will make that loan. And I would say that quite a lot of resources will be wasted. But I think through this measure, we could see that this lack of credit creation that we're seeing, and we shouldn't forget that 97% of all the money is created not by the central banks, but rather by commercial banks. I think that this could stimulate this credit growth and could lead to definitely very an environment of fast growth. But of course, the awakening will be quite rude. So from my point of view, if you have a look at markets are screaming inflation will become a concern, and I think I think it's fascinating because nobody is really seeing it coming, and we wrote a special report called the Boy Who Cried Wolf, and it reminds me very, very much to this story by Aesop about this boy who cried wolf 2 times and nothing happened, and then at the 3rd time when he cried wolf and warned the people that the wolf would attack the sheep, nobody cared about it anymore, and then it happened. So therefore, I think inflation, consumer price inflation, will become one of the most important topics for investors going forward.
Yeah, we've certainly seen a lot more willingness for governments to step in and engage in fiscal stimulus, in addition to the unconventional monetary policies that we've seen now for over a decade. And so you mentioned that we're kind of heading towards higher CPI, and that you mentioned the Misesian phrase about the crack up boom. Can you just give us a bit of a flavor for people that are listening that might not have a background in economics, just what that might look like in terms of their everyday life? What will it mean in terms of going to the supermarket and trying to buy goods? What will it mean for the job market? What will it mean in terms of the way that they currently use their bank cards? What sort of changes might be on the horizon, do you think?
Well, it will probably further increase or widen this gap between the haves and the have-nots. So if you're holding financial assets, if you're holding real estate, if you're holding equities, if you can afford buying into private equity, and if you can take big amounts of leverage, of course, I mean, that's the best of all worlds. But if you have a hard time making ends meet, and if your grocery shopping is really one of your biggest expenses, then you really will have a hard time, unfortunately. And I think this is really something that is very dear to our hearts, to describe this Cantillon effect, and to also tell people and politicians that most of the problems that we're having, the reasons can be found in our monetary system. And all the measures that are taken are only they are scratching the surface, but they don't really they don't change anything for the better. But what is it gonna mean for people and their everyday lives? I think it's something that we're seeing already. Basically, for a family with a normal decent income and 1 or 2 kids, whatever, it will basically become impossible to buy a house. Or I mean, they can take on an enormous amount of leverage and take a big loan. I don't know if they're gonna get it, but the consequence will definitely be that you will have to own assets, and if you can't own any financial assets, you will struggle big time. And I think at some point we're already seeing this when it comes to politics, that the gap between right wing and left wing, this will get bigger and bigger, and in the next crisis, of course, it will all be about higher taxes. It will be about capital controls. It would be about the rich have to pay for all the stuff that is going on. But we also know that capital is, it always goes where it's treated best. So, if you talk to really, really wealthy families, they know how to anticipate those moves and to avoid those taxes and whatever. So it will further affect the middle class. And I think just a normal middle class in Europe, for example, but also in the US, is really something that is kind of dying, and this makes me very concerned, obviously. Now, what does it really mean for you as an investor, as a family father, as an individual? I think at some point we will see, let's say, a reorganization of our monetary system. And if you study the history of money, you can say that, well, most currencies, especially when debt levels were that high, at some point there was some sort of a reorganization of the currency. Currency reform, hyperinflation, whatever. And I think, over the next couple of years or perhaps decades, we will see that's going to play out. So I think it makes sense to try to hedge against those measures. Obviously, gold, but also to some degree, Bitcoin is probably a hedge against this. And I think both prices are already kind of anticipating this. So the price of gold made new all-time highs in every currency last year. It was up 25% in dollar terms. Now, since the beginning of the year, it's a bit weaker. Bitcoin is making new all-time highs. Who would have expected that it's going to go to 50,000? So I think those markets, those prices are already telling us that many smart people are preparing against that.
Yeah. Great. Well, so my final question for you, Ronnie, was just asking if you could sort of elaborate on the scenarios that you see playing out. In the zero interest trap, you talk about different possible outcomes, like the stagflationary outcome or the outcome of us seeing an entirely new, perhaps IMF-based international system emerging. And I just wanted to ask why you think this time is different. We've had crises in the past. We had 2008. We had the stagflation of the 70s. It seems from the rhetoric of your book, you're talking about the current system being pushed to its limits. Like there are some inherent problems that can't really be solved without a kind of breakdown of the overall system. So can you tell us a little bit why, it may be that CPI goes a bit higher and that causes problems for society, but why is it that you think that there's something unsustainable that necessitates a fundamental redesign of the financial system?
Well, if you study history, you will see that those kind of resets, they happen every couple of decades. And in Austria, for example, if I talk to my grandparents, for them it was just normal to experience currency reforms. And if you only held bonds and paper money or cash, you always lost significant amounts of your wealth. So from my point of view, this is not something that I'm not in the doom porn, pardon my French, in the doom porn camp. I think it is something that we have to be very realistic about, and it doesn't, everybody was talking about this great reset recently, and perhaps we're all already in this great reset, but it's not one big boom like at New Year's where everybody is counting down and then it happens, big fireworks. Perhaps it's like sliced like a salami, so small resets happening. And I think of course inflation will be a big concern going forward, and so this is a topic that we are researching for many years already, and we manage a fund that hedges against inflation. So I think really last year was the time of this paradigm shift, and it's not only us at Incrementum, it's also Ray Dalio, for example, talking about inflation. It's Russell Napier, one of the strategists that I really enjoy reading and listening and talking to. He was a deflationist for decades, and now he's saying the next couple of decades will be inflationary. Of course, many people talk about a haircut or some sort of a reset, but it would be devastating for our current monetary system because it's highly deflationary, because every debt that is cancelled would shorten the balance sheet and would decrease, would lead to a fall in our money supply. So I don't think this is really gonna happen. It sounds very, very good and very easy, but most of the times things that sound so easy and convenient, they just don't work. So I think it will be a combination of financial repression. Russell Napier says financial repression is the art of stealing money from old people slowly. So via negative real rates, and if you have real rates -2%, -3%, of course, it has an effect over the longer term. I think that stuff like MMT, helicopter money, will become, a standard tool of politicians and central bankers going forward. I think that higher taxes, wealth taxes, and stuff like that will be implemented at some point. And as I've said, at the end, and I've got no idea when this is going to happen. At the end, we will see a transformation of the monetary system. I think that there's good reason why the central banks that are really important, United States, or the countries that are really important. United States, more than 8,000 tons. Eurosystem, more than 10,000 tons. China, obviously, Turkey, Russia, why they own significant amounts of gold. So I think within this transformation period of the monetary system, I think that gold will play a major role. And this is really, this will be the environment where we won't be talking about gold prices at 1,600 or 1,800. I think this will be a significant revaluation of gold versus paper money.
Well, thanks for that, Ronnie. Those insights, all of them, are hugely valuable. Thanks for taking the time. I know that at the moment you're working on the new version of the In Gold We Trust report. So before we sign off, can you just tell us a little bit about that report, which I know would contain a lot of the ideas that you've been discussing today, and give more information on them? So how can people find out about the report, and when's it coming out?
Well, the big publication day is 27th of May. So the next couple of weeks will be really busy for the whole team. And yeah, I mean, it's the last In Gold We Trust report was, more than 350 pages, quite a break. So it's almost a book, I would say. But we really tried to analyze gold from all sorts of different angles, and it's just, it's about inflation, it's about central bank policy, it's about the debt situation, it's about long-term debt cycles. Obviously, we're talking about gold versus Bitcoin. Why we think they are not enemies; they are rather friends. We're talking about gold mining stocks and so on. So it's really it's a pretty big read, and for me it's always it's hard work, but it is always a pleasure writing this report, researching it, and it is something that is very dear to my heart. And this is now the 15th annual edition, and as you've said, we publish it in German, English, and also in Mandarin. It's available totally for free on our webpage. This is our contribution to educate and inform people about the flaws of our monetary system, the risks that we are seeing, but also the opportunities, and how to make the best out of it. And have a look at our webpage, ingoldwetrust.report. Have a look at our Twitter handles. Have a look at incrementum.li. And yeah, thank you very much for inviting me, Peter. And I greatly enjoy working with you.
Great. Well, thanks very much for that, Ronnie. Thanks again for the insights you provided today, and I hope to talk to you again soon.
Absolutely. Thank you, Peter. Take care.
Thanks, Ronnie.